insight. Thank you very much. Now we move on to China. Chinese regulators have advised financial institutions to curb their exposure to US Treasuries, citing concerns over concentration risks and market volatility. Officials urged banks to limit new purchases of US government bonds and told institutions with heavy exposure to reduce their holdings. The guidance applies to commercial and financial institutions, but does not affect China's state-owned holdings of US Treasuries. The move signals Beijing's cautious approach to managing financial risk amid uncertain global market conditions. Now we welcome Dr. AJ Dua. He's a former Secretary of Commerce and senior economist, joins us live from Delhi. Thank you very much, Dr. Dua, for joining us today. Thank you. Now, what do you think, what strategic message is China sending by instructing its banks to do this? And is this more a symbolic or economically substantive move? What do you think?
I think this is an ongoing move. They have only reiterated what has been happening for the last 9 months. If you look at the holdings of the Chinese holding of the US Treasury bonds, it is the lowest currently at about 682 billion US dollars. Since 2008, Chinese have been gradually reducing their holdings of US Treasury bonds and have been using it, if I can use the word, to where they seem to have weaponized even their capital, their holdings of overseas bonds. And I say this because the adverse impact of their constantly reducing their holdings in the US Treasury, which not very long ago were almost double of it at $1.2 trillion, is now down to 682 as of December end. The reason is the Chinese realize that the US has a huge debt, and the debt is almost $35 trillion. About 20% of it has to be serviced in 2 or 3 months' time from now. And if the big bondholders do not support it, the weakening of the dollar is inevitable, further weakening of the dollar. And once the dollar weakens, then all kinds of things start off in the US. The imports will become costlier, and US, as you know, lives on imports, thrives on those, even though they are now levying tariffs on it. Second, there will be inflation in the US. And third, certain bonds have to be returned in the US denominated currency only. So all those the burden upon the US of if the Chinese keep on bringing it further down would be that their overall debt level increases, inflation comes in, as well as their imports become costlier with the dollar becoming weaker. So I am afraid that the US economy could take a major hit, much more than it did when it started off only so-called Liberation Day, when the tariffs got imposed on the rest of the world.
Thank you for highlighting that. And so what risks does China and US both face by this move?
Chinese should also realize that they may not have borrowed heavily abroad, but the Chinese GDP, the debt GDP ratio is pretty high. It is as high as 3 times, 300% is the Chinese debt of its own GDP. The US debt comes out higher at 400%, and despite the US GDP being almost twice the level of the Chinese. So the US has huge debt in absolute terms, but China is not insulated altogether. Unless the Chinese economy grows and the fiscal requirement of the government to hasten the pace of the growth comes down it gets left to the open market and the foreign investment coming in. Both the US and China, with their huge debts, and they are number one and number two size countries, with number three, number four, Germany, Japan, India, being in that order later on. We
Yes.
could all feel the pinch of their own currencies weakening, and I would think that the sooner there is an orderliness brought about in the internal debts
Yes.
and the foreign holdings, the IMF may have to play some role in it. Not that it can be very effective, because the levels of borrowings which we are talking of are humongous, far more than what the IMF can even manage.
With that, I would like to thank Dr. Asia Dua for joining us today and sharing that insight with us. Thank you very much.